Welcome back. This is Tax Pros Unplugged. My name is Jared Foose, and I'm with Kelly Bender, the ever opaque dressed Kelly Bender, the professional that is my yin to her yang. Welcome back, Kelly. How are you feeling?
I'm hanging in there on
Yeah,
a morning. It's like just one of those days today. So
yeah. I feel
I'm
like
here.
yeah, it's been one of those weeks, and it just feels like a lot of different feelings, a lot of different thoughts, things like that. But
Yeah, lots happening, and then we have like this pesky deadline,
oh,
and that I don't know. Now you mentioned before, are you like a no extension kind of firm?
we try very, very hard to do no extensions. I mean, we have a couple just because, people procrastinate and I'll be honest with you, like procrastinators are like the first clients to like no longer be our clients because we're not a firm that can really sustain doing extensions all year long. So we try to get them all done because, like you, I'm gone a lot. It's one of those things where I think October, I mean, it starts next week for me. I'm gonna be gone next week, but October, November, and really it goes all the way till December 15th for me, where I'm just not home and I'm just not here to do the work. So we have a couple. Actually, out of this office that I'm sitting in, we are completely done with extensions as far as business returns. I think we have a couple individuals, but
Hmm.
we got less than 10 in this office.
Wow.
So I mean, it's a good feeling. Every firm's a little different, right?
Yeah.
Like some firms love the idea of having that work throughout the year. Not me, man. I want to work like a dog for 95 days, and I want to be done.
You're the
So
100-day sprint guy.
yeah, 100%.
Yeah.
Well, let me do this. We're going to continue our series on what we wish taxpayers knew. I know we're going to talk a little bit about some horror stories that you and I have seen. And I'm sure there's going to be some random things that we also get into. But quick disclaimer, this is educational purposes. Do not think that Kelly and I are giving you tax advice. Please consult your tax advisor for specific advice relating to your personal situations. I know that maybe you forgot that. We got to probably record this and probably just inject that every time because I've spent a week worrying about it, like for the six people that are listening. So, but anyways, Kelly, what type of things do you think? Where do you want to start? What do you wish taxpayers knew? And I've been thinking about it for 2 weeks. But what do you wish taxpayers knew? And typically, let's talk about some specific examples. What do you want to talk about?
So I think we kind of, I think we did a good job. The first one, we kind of talked about retirees and some of those older client issues. And then last week, we kind of focused on small business owners. And then I think the third, which is actually the largest group of individuals, is just normal, traditionally waged employees, people who receive a W 2. And those are still the vast majority of individuals in the country have a level of a traditional W 2 and are just normal, quite normal waged earner. And I won't lie that this is not the place where you can find the most of the tax benefits. Like the tax code is not necessarily written completely favorably for the traditionally employed, but that doesn't mean that there's not a lot that goes into it. And I think this group of people, what I see a lot is that there's a base level education of how your earnings are coming into you that I like to explain for people so that they understand, the nature of your earnings, and then sometimes asking questions. So a lot of times companies have options for people to do things that are very tax favorable, and for whatever reason they don't communicate those savings to their employees very well, and then the employees are just showing up with a W-2 to us at the end of the year, and we're like, oh, I mean, don't you have some of these options? And so I think that's what I wanted to unpack with some of the things that we see that are there. Doesn't mean that everybody has all of these things available, but uh, I think that's a good place to start, is like, what are the options that you have if you're a regular waged employee?
Yeah,
So
I mean, we can talk about our top things that we see in W-2 earners. Is like, this is the question we get all the time. Should I have a traditional 401k? Should I have a Roth 401k? Is the HSA something that we should entertain? What is the HSA? How does it work? Because let's be honest, like a lot of employers, they don't come out and just explain all this stuff to employees that how do they benefit from them, and it's not the company's fault, I guess, in some aspects. Like, I've yet to meet an HR person who is the person everybody goes to for their benefits and HSA that have been able to effectively explain the benefits of these. So why don't we start with something simple as this is maybe off the wall. Maybe I'm going crazy here. Maybe I'm steering us in the wrong direction. Why don't you talk about W-4s first? Because I feel like it doesn't matter if you're 6 or 60. No one knows how to fill these out. And it's just, it boggles people's mind that that little piece of paper makes such a huge difference in their tax situation.
Yeah. Yeah. I mean, I think that I God help us, I don't want to like unpack how to fill out a W-4 because
No.
I'm not actually sure how to do it either. Just, I mean, every single time I look at it, I'm like, who invented this form and what level of like
Well, it
drugs
got
were they on?
worse.
I mean,
It got worse after TCJA, if you
got
remember.
worse, and it doesn't, it's like filling out a tax return. It's so misleading. It doesn't make any sense to people. Yeah, so the W-4, is this form that as soon as you get a job, your employer hands you a W-4 and you fill it out. And what a lot of people assume, and I see this, we always see this at tax time, a lot of people assume that your employer is then responsible for taking out the right amount of taxes for your personal tax situation because you filled out a W-4. And what people need to understand is that the employer really has no obligation to make sure that your personal tax situation is done correctly. They take the exact data that you gave them, throw it into a computer system, and then we have this, I don't even know, how big is the Pub 15? Like the withhold, there's this huge publication that tells employers based on how often you pay, how much they get, all this stuff, how much you take out of each person's paycheck. And not like you're doing this by hand. This is all computerized at this point. But the point is, I could have 5 people lined up who all make $50,000 and they could fill out a W-4 differently and all have a different situation at the end of the year, right, wrong, or indifferent. So that W-4 and getting that part right is really important. And if you don't know how to do it, that might require some help. But you can also kind of check on that first pay stub. And this is where I try to teach the responsibility is to the person who earns the money, not the employer. And it's easy to get mad at our employers and say, hey, you should have told me, but your employer doesn't know either. And because they don't know your personal situation, they don't know how much your spouse makes, they don't know how many kids you have. I mean, maybe they do, but they shouldn't probably know how much your spouse makes. And so then look at that pay stub when you get it and look at the line on the pay stub that says FIT. Federal income tax. And that number is the per pay representation of what is going to go into your big bucket for taxes at the end of the year. And that's the big thing that I like to teach people first is like, let's look at the pay stub and understand what we're looking at.
We've tried really hard to get into some schools, some high schools, and we try to start having this education with some high schools when kids turn about 16 because they're going to be driving, potentially getting jobs. And we want to teach them, like, the general rule of thumb is until someone tells you to change this, you be single with no exemptions, no kids, no credits. You keep it single and zero until the day someone like me tells you to change it to married. But I can tell you, at least in my experience, we have these high-earning individuals. I just got off the phone with one of them. They're doing like $400,000 of W-2 earnings per year. And I told her, I said, you have to change your W-4 at work. And she's like, well, I don't want to lie on the form. Well, I get it. You're married. You have 3 kids. You're not lying on the form. That form is telling your employer, I want more withheld. You're not lying. I get it. It's one of those things where, like, but I feel like I'm going to get in trouble. I'm concerned that they're going to come with black SUVs and I'm going to get home and they're going to be in my front yard because I filled this out single and zero and I didn't tell them that I'm married and I have 3 kids. So the issue is and I'll just wrap this up for us in this aspect, that there is no one person, even if you're doing payroll every day, no one can tell you how this algorithm for the most part works, because the government turns this dial every once in a while, like every quarter, every month, every time that what you had withheld, if you're a salaried individual and you're making $50,000 and you're on a biweekly payroll, your paycheck's the same every time. And sometimes your federal withholding is a little bit different throughout the year. So it's not always up to the payroll processor or the clerk that's doing this. It's the algorithm that's behind the scenes.
Right.
But making sure that you have this filled out appropriately ahead of time is huge because we've seen the ups and downs of this. Prior to COVID, we had, prior to 2018, we had for lack of a better term, a worse tax rate generally and less tax benefits. So the withholding tables were withholding more. Well, when all that tax law changed in 18, none of the withholding tables changed quick enough. So you saw lots of people getting bigger refunds because they were overpaying for 2 years. Well, that swung hard the other way, and we started seeing people in 22 and 21 owing money because their withholding had changed and they didn't change their W-4 to account for it. So, and coming back to what we wish people knew, I wish people knew how to fill out a W-4. You talk. I talk about bringing crayons out, right? I bring a whiteboard to business owners that we do payroll for. I'm like, here's how this works.
Here's how it works.
Yeah.
Well, I think the other thing, and you mentioned it, the other thing that I wish a lot of people knew who earned their money through through a paycheck, and I can't scream this enough, but getting a refund at the end of the year does not mean that you won the game. And with traditionally people who fill out or who work W-2 jobs, for some reason, when the W-4 changed and they started getting these lower refunds, they didn't understand. They thought my taxes went up. And in reality, they got more money in their paycheck all year and their taxes went down. But there's this weird disconnect when people do taxes at the end of the year where they think that the amount that they owe or get refunded is the amount they paid in tax. And that is not the case. And so when you look at your 1040, there is a line that says total tax. And I don't know the number because, I'm not that much of a nerd and it changes every year.
Yeah.
But whatever the line is, it says total tax. That is how much you pay in federal income tax. Then you calculate how much you withheld from your various sources. And I wish people understood that getting a refund means you gave the government an interest-free loan for 12 months or more, because you may have started doing it in January of the previous year and you don't file your return until April of the following year. You gave the government an interest-free loan to then return that money back to you. And like I always say, I am a better steward of my money than the government. And so keep that money in your pocket. Don't give it to the government interest-free for 12 plus months.
And there's nuance to that, right? I mean, if you're getting a refund, it's either you overpaid or you got credits on your tax return that are refundable. Mm-hmm. The way I always try to wrap this up in a bow for people is if they're buying something on layaway or putting payments towards it, the withholding and things you pay in throughout the year through your paycheck, those are your payments towards a future bill. So when you go to actually pick up that product or whatever you're planning on buying or whatever you're making payments on, tax time, whether it's April 15th or whenever you file your tax return, if you get a refund, you've overpaid your money for the most part, which means you could have probably used some of that money for living expenses or whatnot. If you underpaid, that means you didn't pay for your whole bill yet. It's the reconciliation or it's the culmination of your year, overpaying, underpaying. And from your and I perspective, I would much rather owe a little bit, not a bunch. I'd rather owe a little bit, but I can also understand where taxpayers are not like you and I. They use this refund for different reasons, and they're getting this refund for different reasons than what we are when we overpay. So a lot of taxpayers fall into that. I think there's a select group of people that get these refunds that are sizable or regular because they've got kids. And that's a completely different situation too. So, what about, we kind of hit on it a little bit. What do you think that you want to, in regards to things you wish taxpayers knew when it comes to let's just talk about it right up front because this is very open ended. Who knows where this is going to go? 401s and retirements, and I use the acronym 401, but it could be simple, it could be SEP. I mean, it could be any of these weird acronyms that are in front of traditional versus Roth. Let's come down to this. Let's not ask about 401s. Here's a better way to ask this question, Kelly. When taxpayers ask you about should I be in a traditional account, a pre-tax account, or a post-tax account, what do you wish taxpayers knew?
Yeah. So this is a good one because I think when we talk about it with the individuals who are at jobs, the first place I always ask, like usually the question comes, what can I do to save money in taxes, right? And that's the start of the conversation. And then from there, we say, well, let's start to look at what options you have at work. And so when it comes to savings plans, retirement type savings plans, or possibly HSAs, FSAs, things like that, it's like, let's unpack what you have available at work and start there and then, build on it. So when people want to save money in taxes, I usually flip that conversation to, do you want to save money in taxes now or later? And sometimes we have very high earning individuals, and we've kind of talked about this a little bit before where, it's very appealing if I'm in a 32 or, 37% tax bracket to absolutely, I'm going to max out my available 401k at work in a yeah.
Okay, so I think that one of the things that one of the pet peeves that I have, I love asking the question when I get somebody that's a high earning W-2 in here and they owe a little bit every year. They'll talk about like, well, how do I save on taxes? And they're throwing money into a post-tax account, a Roth 401, Roth simple or whatever that they have. And I'm like, well, are you trying to save taxes now? Or are you trying to save taxes later? And the question I like to ask them, here's the $1 million question. When you get to be retirement age, what is going to be your income? Do you think you're going to be paying as much tax as you are now? Do you think your income is going to be at the same level as it is now? Or are you in your peak earning years? That's a good question, right? And the problem that I think that, and I don't like to pick on financial advisors, I hate the saying taxes are always going up. Like I said, one of the first things we talked about when people say taxes are going up, I believe that's an ignorant statement. That's the opposite of what's happened in the last 7 years. So do I think that there's a chance that taxes could go up? Yeah, the sun will rise tomorrow potentially. Who knows? But the key is nobody knows how to answer this question either way, right? I think that there's probably a fine line. Meaning if you're in your peak earning years, you're earning this big money, you're spending, let's say north of 25% in income tax, it's potentially better. And if you're raising kids at this point, let's save our tax dollars. But once again, nobody can answer that question effectively because it's a 50-year question or a 40-year question. So that's where at least I love asking, what is your income going to be when you're retired? Because that's the same answer. I don't know.
Yeah, that's what I think too is what do you think is going to happen now and later? Where are you? Or is this just a one-off thing that you're earning a lot now? You don't think you will be in the future? But it's always a flip side conversation. I've said that is like, just because you can put money into a pre-tax vehicle now that means then you're going to have to pay tax on it later. And I don't have that crystal ball to know what that income is in the future.
Yeah.
But what I will say is for a lot of people, and so, I do think that taking pre-tax deductions, maxing out 401ks and things like that are great options. But I also think that you should investigate if your company has ability for you to save into a Roth 401k, which a lot of people don't know that they have that option at work.
Right.
And all you have to do is sometimes ask is that if you're on the lower end of the earning spectrum right now, maybe you're brand new into the workforce and you're not earning a ton yet, ask if your company has the Roth 401k option, because that's like a no-brainer. It's so easy to get into, and you can save more into that Roth 401k than you would be into a Roth IRA. with a much easier barrier to entry. So that's also a really nice thing to talk about with people who are, maybe on the younger end of the earning or lower end of the earning, and they're like, well, I can do this. Or the flip side is if you're on the higher end, but you are now into a situation where you would have to do backdoor Roths. What if you have a Roth 401k available at work and you want to get into that post-tax bucket? Use that Roth 401k first at work because it's so much easier to get into. It's just automatically available to you.
Yeah, I think that you hit it on the head. There's phases of life. Like if you're out of high school or just in college or out of college, that's a great time to really consider the Roth option because what are you really paying in tax potentially? You're paying tax 10, 12, 14% maybe. You know what I mean? And by the time of that age, if you were putting into a traditional account at that point, that a pre-tax account, that money, I mean, was that Rule 72? Every 7 years or something like this thing's going to double. I mean, by the time you get to be 70 years old, there's going to be there could be a massive amount of money in there. And if you started putting that money into the Roth compared to the traditional, your RMDs, your required minimum distributions, they could sting a little bit just because of when you put this money in and how it's grown and things like that. So I agree with the idea that that timing is everything, what stage of life you're in. I think that when it comes to if you're, I think there's a massive group of people out there. Boomers are huge, right? That's a huge generation. I think that there's a huge group of individuals, and I want to say probably 45 to 25 that are becoming entrepreneurs that are, or looking at becoming entrepreneurs or just trying to find any way that they can save money right now, just with inflation, the cost of homes, all of this stuff, right? Those are all factors, at least in my head. And I like to entertain the idea of trying to save as much money, keep as much of it in my pocket right now, because the things that I can't control, I just want to react to and try to do the best job I can for facts and circumstances of whatever stage they're in. So, what about let's talk about HSAs a little bit. Do you like them, hate them? What's your thoughts on them? I mean, I have my opinion, but I'm very interested in hearing what Kelly's opinion is.
I think the HSA is like the number one cheat in the tax code. So
Thank you.
I'm so excited about the changes that just got made to HSAs to allow them to be more accessible. I think for whatever reason, whoever the lobbyist was that promoted HSAs whenever they came out, this is the number one thing that I tell people. If you have the opportunity to get into an HSA, do it. And I actually, sometimes I might put this above retirement accounts. This is so valuable. And they're so cool. And so I'll break that down. HSAs, health savings accounts. Okay. And we'll caveat and talk about flex spending, I think, as well. The FSA, I think, because it's important to understand the difference. But for an HSA, these are health savings accounts. These are essentially created bank accounts that you can use for health expenses. And you can put the money in through usually an employer, or if you're self-employed, you can do an HSA eligible plan. But HSAs are triple tax free. So they go in tax free. And most of the time, these are tax free across all entities. So like I'm in the state of PA, everything gets reduced when you put money into an HSA. So we're talking federal, Social Security and Medicare, state, local, like everything you don't pay tax on when you put the money in. So all of those taxes, you put money into an HSA, you don't pay tax on it. Huge. That doesn't happen. And then for a lot of people, there's not an income limit on this, which is massive because a lot of people get barriered against getting into some of these things when they start making too much money. You don't on an HSA if you're in an eligible plan. So great. Goes in tax free. Once it's in there, if you accumulate money in the account, it can be invested into the open market, into sort of different funds. I know that's how we have ours set up for, is that ours is the base savings part. Oh no. See, I did it. Okay.
This is
Kelly
why
has
it
a
pays
smart
to have a
camera
stupid.
that doesn't.
Yeah, this is why it pays to have a stupid camera like mine. That's like, okay, I just have to move my face closer. And for those who are just listening to audio, right now, Kelly has basically unintentionally zoomed into her forehead with this camera that she has in her home office.
Because because she uses her hands to speak and she can't control her hands. Wait, come back. No.
I think it'll help if I do it from my end, if I just use my fingers to come back. Oh, there you go. Look at you. See, I told you I had to do it too. If I'm doing it from my end and you're doing it from your end, it's guaranteed to work.
It's guaranteed. It's great. Okay. You said that was going to happen too. Okay, don't use your
100%.
hands in squares. That's what I have to do. It's like
Oh, that's
keep them
great.
locked.
Whew,
Okay.
this is 2 times now. You have digressed. You've train railed
I
yourself.
have. I'm telling you. I told you at the beginning. This was like a day. I'm off the rails today.
Oh gosh.
Off. Oh gosh. Okay, we're growing. What are we doing? Oh, the HSA. We're growing it tax free. It's invested in the market. And then if we take it out and use it for health expenses, we get to take it out of the HSA and not pay tax when we take it out. So it goes in tax free, it grows tax free, it comes out tax free. There's nothing else in the tax code where that happens without income limitations. And so that's why I love the HSA. I think it is like the number one thing. And a lot of companies do have eligible plans, but employees don't know enough about them to know how powerful they are. And so these are great savings vehicles. And nobody thinks that their health expenses when they, if you have kids and when we say health expenses, that's a broad term,
Yes.
right? I mean, you
Yep.
can use these things for all kinds of stuff.
If it qualifies to be a health deduction on your Schedule A, it will qualify as a health expense for the HSA. Like you talked about Pennsylvania because you guys have localities, municipalities. Ohio's worse, and
You
that's
guys
where I
are
hail
bad.
from. We have federal tax, obviously, Social Security, Medicare, state tax. We have school district tax. We have city tax. So when I tell people about this HSA, I explain it to them. Look, I want just to compare. Let's just compare the 401 and the HSA. Now, the 401, we're not going to disagree. You can put way more money in that 401. I can also put in the HSA, what is it, like $8,700 or something that this year. This is one of those things I have to look up until I retain it because that number changes every year.
Every year.
For a family plan. It might even be 9. I don't remember.
I think
Don't know.
85.50.
I don't remember. It doesn't matter at this point, but we can probably get that number pretty
Nine-ish.
quickly. But let's just compare let's just say $8,000 into your traditional 401k versus your HSA. In Ohio, at least for most of my taxpayers, let's just say that they're at 15% in federal tax. Okay. They're going to probably pay to 3 to 4% on their state income tax. So we're talking about 15 to 19% tax savings by putting into that retirement, that pre-tax retirement. Now, if we put that same money, $8,000 into an HSA, and I'll give you real numbers here. So what did I say? That was 18%. So $8,000 times 18%. That's a $1,440 savings between federal and state. If you put that same $8,000 into an HSA, then you're going to save on federal, you're going to save on state, you're going to save on Social Security, Medicare, school district, and city. So let's just say 30%, okay? Because that's the difference. So we're talking about $8,000 times 30%. That's $1,000 more in tax savings across the board. My favorite thing about the HSA, because people change jobs, they change health insurance, you forever keep this HSA in contradiction to the FSA. This is forever your money. My other favorite thing that I want my clients to look at this HSA as if they need it for health stuff, they use it. But if they don't need it, you need to treat this like another retirement account. Mm-hmm. Because once you turn 65 and whatever's in that account is going to be treated just like a traditional IRA. Now, the other caveat to that is if I'm 65 years old and I got $60,000 in my HSA, I can pull that out. It's not tax-free anymore if I'm using it for something other than medical, but it's treated just like another retirement account. However, I hit 65, I'm going on Medicare. I can reimburse myself for my Medicare premiums. That is huge. We're talking about $2,000 to $2,000 a year potentially that you could be pulling on this HSA and still paying for medical out of the HSA, so it's still tax free. And now I can pay for something that I'm already going to have to pay for or reimburse myself for, but I saved 30% the whole way.
And you never get a deduction for paying for your Medicare premiums in any other way
Nope.
except for using this long-term plan of an HSA. So I agree. I had a feeling we were going to be on the same page.
I love them. I love
I
them. I just,
love them. And like I said, I love them because of the no income limitation. Because when we talk about, a lot of things for individuals, I mean, I get frustrated when people say, oh, the people at the top end of the brackets or the rich don't pay any taxes. That's not true. The higher the income tax bracket that you rise through, the less you are able to take certain levels of deductions. Everything gets limited by income at every stage of the game in almost every scenario except for the HSA.
yep.
So it's just one of those where you don't have to jump through hoops. You don't have to, do all the things. If you have it available at work and your employer offers this, please, we're guaranteeing you to save money. Put money into an HSA. And a lot of employers may actually make a contribution to it
Yeah.
for you as well, which is
A
huge.
good deal. It's a good deal.
And so it's just such a great savings vehicle.
And if you're an employer, you have benefits for putting money into that because you
Yeah.
also save on Social Security and Medicare.
Right.
So the only downfall to the HSA, this is the only downfall that I can see, is if you're a family or a person that has chronic issues, health issues, like the high deductible. Everybody's terrified of the high deductible. You have to have the high deductible health plan to qualify. That qualifies for an HSA. But every year, my wife and I go through the actual math of this. If we took the best policy without the high deductible, if we took the HSA, dollars and cents, what's a better deal for us? And every year, some years it's better than others, but I've not had a year yet that the HSA dollars and cents wise for us is better. That's not better than the other PPO plan or whatever it is that they offer. But I can see where somebody's like, well, I don't want to spend $9,000 out of my own pocket. Well, guess where that money can come from? The HSA,
The HSA.
that you saved an additional 30% on compared
Right.
to out of your pocket. So
Well, and I think that with some of the changes, and I mean, this has been happening, but I think that if you haven't looked at this in a while, do so. Look at what an HSA eligible plan is, because what used to be high deductible plans, when these things came out, high deductible plans were like $20,000+ a year out of pocket. It was insane, right? But now, I mean, high deductible plans, and just particularly with some of the OB3 changes. Now, I don't know if those are into effect in 25 or 6, but like so many plans qualify, and the out of pockets are like, some of them are as low as like $1,500 or $2,000. And that's now considered high deductible or something like that. The rules are not nearly as rigid. The point is, the rules are not nearly as rigid as they were when they came out, which makes these things even more appealing.
well, and you just kind of hit it on the head. Like the gap between the high deductible and the PPO, it's kind of closed.
Yeah.
Like the PPO's coming up. Like the cost of those PPOs, for like the premiums per month, and then your out of pocket and your deductible. Like the gap's closing a little bit. And I had to double check these because you were right. Family coverage for an HSA is $8,550. For single only is $4,300. And obviously, if you're above 55, you can do that $1,000 catch up, meaning you could put $1,000 more in it. So
Right.
good job, Kelly. I'm
Yeah.
just a year ahead in my head.
Yeah, that's okay. You know what? I only looked at it this week. That's why I say that. And this is a weird year. So for some weird reason, like normally the single double, this year has been weird to me about it. The normal, like if you're single, you said 4,300. The family would be double that, which would have been
Yeah.
8,600. And then for some weird reason, they dropped $50 off. And I think just somebody in Congress like screwed up when they wrote it, honestly, because that's usually what happens.
Well, like anything else, it never benefits you to be married, right? That's for tax code wise.
Yeah. Well, that's a good segue. That's another thing to talk about.
Yeah.
for
We should
wage
talk about filing
earnings.
statuses. How are you supposed to file?
Filing
I'm married,
status.
filing single.
Yeah. Filing status. I'm married, filing single.
That's
Yeah.
a joke for everybody that doesn't understand. Kelly's allowed to laugh at it, but if you don't know what I'm talking about, it's okay.
Yeah. Filing status is huge. So we have joked about this, and our friend Catherine does have a saying that if you're married filing separate, you have no right to live.
Yeah.
Is that right?
Yeah. You
And
got married filing separate has no right to live.
no right to live. So the filing status, particularly now this year, is going to be really important. So what I wish, and this happens a lot, when we have brand new married, my favorite, so cute, you're so happy, and you got married, and you're
They
like,
have
you know
no
what?
idea.
We're gonna file separate this year, and I'm like, or we're gonna both file like single, and we'll do the married thing next year. And I'm like, yeah, it doesn't work like that. So if you get married at any day during the year, you are considered, in the eyes of the IRS, married all year. And so you don't get a proration or a get out of jail free card. Like, this is one of those, you're married for the whole year. And so what that means is this married filing separate status has a whole lot more restraints, I guess is the way to put it. So if you choose to file separate from your spouse, and there are very legitimate reasons for people to file separate from their spouse, and sometimes they're not always tax incentive wise. Sometimes, you know,
Liability.
a liability, right? I mean, I see this with, one has all the businesses and they choose to file separate to restrain the liability from the spouse, even though they're on good terms and everything like that. But there's other reasons to it. But if you're going to file married filing separate this year, particularly, there's a lot of things that you're not going to get from a deduction perspective that will greatly increase the amount of taxes that you both will pay versus doing joint filing and putting all of the income on one tax return together. So the filing status thing is going to be big this year, and I think I don't know about you. Have you seen this with? We've had an increase in the married file separate filing status with people who are trying to get like student loan forgiveness.
Yeah. So Ohio is unique too, and this is just a segue, but Ohio is unique because we get a benefit on our state to go separate. So a lot of times, and really what it comes down to is in Ohio, if your income is close, like between you and your spouse, if you both make about $50,000, when you separate those tax returns, what we lose on the federal return, we usually gain up on or get better benefit because generally speaking, this is just an oversimplification, but married filing joint on the Ohio, we're paying 4%, but married filing separate because we're splitting our incomes, we have 3%. So that extra 1% makes up what we lose on the federal side. So Ohio is just unique because of the married filing separates, but you're right. And OB3 changed a lot of this, where a lot of the student loan forgiveness or things like that, these policies that were out there, and they've been out there for a long time. We're talking about Obama years.
Yeah.
There's no more benefit to going separate because of these new policies for what? Okay, this is what we need to say. If you are a taxpayer going married filing separate because of a student loan situation where it's a repayment or it's based on your income, and that's why you're going separate because your income is less than maybe your spouse and you put together, that is going to change drastically. You're going to have to talk to your tax pro and specifically cite OB3 and the new rules that come from that. I don't know if we want to dive into that. I don't know if you want to dive into that, but I think it's probably case by case. It's state by state. And I always laugh, and I'm going to tie this back to the W-4 situation. I get young couples in all the time, and I jokingly, I'm big on marriage advice. And
I was just going to say that. I mean, this is your time to shine because
this
you're
is
going
the
to give them
moment.
marriage advice, right?
Yeah, this is the moment that I'm like, ooh, I light up like it's Christmas morning, and I get to unwrap a present for these people.
You're like, I'm so glad you found your soulmate.
Gosh, you're gonna lead me around this rabbit trail. I'm gonna resist though. Well, my favorite thing to tell these people when they're getting ready to get married, I'm like, look, don't change your W-4. Like, remember that whole rite of passage, you're carrying your spouse across the threshold of the house and all this other stuff. Like, automatically, as you're doing that, you're filling out your new W form that says married with no kids. Don't do that part. You do everything else to consummate this whole thing, but don't do the W4 at work until I tell you to do this. But married couples, like or even divorcing situations, that's another aspect that people are like, well, we were divorced like December 20th. Like, we're going to have to file a married filing joint. I'm like, no. And court systems. I don't know how you deal with this, but court systems, the divorce is final December 20th. And the court's telling them they got to file married filing joint. Here's the simple saying, and we could probably wrap up some of this with a bow. Whatever you are on the last day of the year, 12/31, is what you are for the whole year. So if you're a carbon-based life form that happens to be attached matrimonially by another carbon-based life form, you are going to file that married filing joint or married filing separate. You don't have the option for single. And the only thing I like to point out about married filing joint is a lot of people think it's the default. Tax pros think it's the default. But in reality, both parties have to elect or agree to be married filing joint. I mean, this could tie into our potential next segment about horror stories. But there are so many things and reasons that maybe financially we don't want to be filing joint because of potential liability. I've got lots of stories of those. We don't have to cover them all today, but
Yeah.
So
No, I agree with that. I mean, I don't know about you, and we talked about the, divorce situation, which is always so terribly unfortunate. And what happens is always, there's just this whole myriad of events and emotions and all the things. And then same thing, for some reason, everybody just thinks, oh, well, we have to file married filing jointly. And in that circumstance for us, we actually always strongly recommend that you start by doing married filing separate if there is a separation occurring in the year, because even if you're not, divorced yet, like you've separated or you're in the process of or whatever, because like you said, what people don't understand is the married filing joint choice on a tax return is irrevocable. And so if you start there, you can't go back to married filing separate.
That's an excellent point.
But if you start at married filing separate, you can choose to go to married filing joint at a later date through an amendment. And so if you're in a divorcing situation or a separation situation, the safest option, even though it's not always the cheapest, is to start separate until everybody's sure that the dust has settled in the way that you intended and wanted it to. And then if everybody, the emotions, smooth, and I've done this, like people have gotten back together or we came to a divorce agreement, everybody came to, okay, let's go back and we think it's safe, both parties agree we can do a joint filing. You can go to joint, but you can't go the other way around. And so that one's really important, I think, for divorcing or separating couples to understand about that election.
Can I tell you a quick funny story?
I'd love it.
So it was probably 2 years ago. I have been doing this couple's tax return for, probably 8 years or so. Nice couple. And I do all these appointments with them in front of me, right? They're sitting across me, and we always ask the same question. Are you guys still married? Right? Seems like a simple, straightforward, yes, no type answer. They both looked at me and said yes. Didn't expand upon it at all. I get the tax return completely done. And during the conversation, and when I'm doing this tax return, they're like, hey, I'm going to go have lunch with Susie or whoever it was. And I was like, who's Susie? And they're like, oh, that's my wife. I'm like, hold up. Wait a minute. This is your wife. No, we got divorced this past year. We both got remarried to different people. So I was like, all right, well, this is everything I just done for the last hour. I'm going to shred or not print and delete because you guys are not married to each other. So I had to start asking the question when I'm doing taxes, are you guys still married to each other? Because you would think that would be a straightforward thing, but I had a scenario where they believed, because they were married to different people, that because they were married to each other the majority of the year, they believed they had to file joint. So, and you'd think I'm a fairly good. I probably should work for the TSA because I feel like I can read people a little bit. But you'd think I would have picked up on something that there was animosity or whatever. The only thing I picked up on was, "Do you want to join us for lunch? Because I'm going to go meet so and so." The only way I knew
Yeah,
that they weren't married to each other.
I don't even have words for that because I mean, so you're like married, divorced, and married other people, both of
Yeah,
you,
yeah.
in the same 12-month period of time. And I don't think like I have been divorced, and it is not a quick or easy process. And then to turn around and remarry.
This
in the
happens
fir-
with older. This happens with older folks, right?
I mean,
And
maybe after death, I can see
yes,
it with
wholeheartedly.
okay, totally fine. But I mean,
This happens all the time. And what do they call those? Like retirement home cowboys? What do they call them? I don't
yeah.
know what the verbiage is, but
Yeah. It's a real thing. It's definitely a real thing. Wow. Okay, so the question now is, are you married to each other?
to each
That needs
other.
to be. I like
A-
it.
And we should probably say, as of the 12/31 date, we should probably have added that. But you wouldn't think
Yeah.
I'd have to
Yeah.
add that. But
Okay. Well, that's a good segue to horror stories. Do you want to like I thought that this would be kind of fun for a couple minutes is like people
do you want to kick this off, or do you want me to kick it
you
off?
I'm gonna start with you and
Okay.
see how good I have to level up to get to crazy.
Well, I
Because
love this story because it ties in with our filing statuses, divorce,
yeah.
retirement, all that kind of stuff. So a couple years ago, we had a married couple, and I believe the whole saying that there's nothing worse than a scorned woman. Like fear has what is the verbiage that they
Hell
use?
hath no fury like a
Yes,
scorned
hell hath no fury like a scorned woman. So this couple comes in. This guy owns a Schedule C business. He's a construction guy. She is a W-2 employee, works for a job, and they sit down at our desk. And the body language, my God, is it bad? Like you can feel the hatred for each other, right? So they talk about the idea that they're potentially going to get a divorce and they want to file whatever's best financially for them. That's the conversation that they have. So we do the whole tax return. We submit it and we e-file it. It's gone. Married filing joint. Now what we did in that moment was we still got a potential conflict of interest unsigned and all this stuff in case, to CYA. But we get a phone call. Now this filing probably happened in March, middle to late March. We get a phone call and a couple days later. The wife calls back and says, "I don't want to file with him." Now you hit on this from the idea that once you go married filing separate, you can amend to go married filing joint. But once you go married filing joint, you can't amend a tax return to go married filing separate. But if it's before the due date of the tax return, April 15th, you can file a superseding tax return. So I love bringing this up in a horror story because this happened in my office. I love throwing this at tax pros and saying ethically, this is all ethical, right? Like, so moral of the story, she came back in, we filed another tax return, but we had to mail it because it was already accepted for the joint tax return. But that situation, and really what it came down to, is because she believed that he was not claiming all of his income, or he was writing too many things off. She wanted no liability associated with this soon-to-be ex-husband. So that is I don't know if it's a horror story, but it's a weird story. And I love hitting that with tax pros. Like, what are you supposed to do with this? And you'll be surprised. You may not be surprised. You'll be surprised at how many tax pros don't know what to do with this.
Yeah.
Or that would breach ethical obligations.
Mm-hmm.
There are so many tax pros out there that would go out there and tell the ex-husband or soon-to-be ex-husband he's got to refile a tax return, which I can't ethically do.
Mm-hmm.
And I hope to God that this ex-husband, which I've not seen since, is not listening to this or will listen to this and be like, "Jared, what the heck, man? Why didn't you give a brother a heads up or something?" The reality is I don't think the IRS ever caught this or saw it.
Yeah.
I don't
They
know.
don't. Right.
So I don't know if that's a horror story, but that's a unique and weird story.
Yeah, that's a weird one. And I mean, I agree. There is this conflict status, and I don't know how it sounds like you're doing the same thing. So we have The minute there is an inkling, it's an immediate conflict of interest inside of our firm. So if I have a party that calls and says I separated, it's an immediate trigger, whoever takes that call, and we absolutely must have a conflict of interest sign because so many horror stories arise. And I think, it's an unfortunate situation. I always try to give people the grace of the moment, but this stuff does matter. And sometimes it matters, with big dollars when people are in these types of situations. And I think that leads to one of my horror stories, which is a lot of mine relate from business side of, I love small business owners, but there is a wild, wild west that exists in business owner world. And I wish that people would do better about having appropriate legal counsel or any legal counsel, and then also tax counsel. I don't want to say I should be first, but I might be able to guide you better if you asked me first. Most of mine relate to business stuff that is so messed up. So we had, it's funny, this is actually divorce related. One of our acquisitions. So I didn't prepare the early years returns. When I met the couple, as I knew, per the prior year, was an S corporation with two owners, husband and wife, 50-50, not anything uncommon. Never thought to question that until the call about the impending divorce comes. And then the corresponding call from husband saying she says she's 50% owner of the business. I'm the sole owner of the business. This whole thing. And I'm like, where does this come from? I've, for as long as I've known you guys, a couple years now, it's been 50-50. And lo and behold, we uncover that it may have been a little bit premeditated, but previous, so it was like 2 years, whatever. So 2 filed tax returns as a joint.
Yeah.
Here we go back to the original paper documentation. And again, this is like, right? It'd blow your mind.
I know where this is going.
I find a piece of paper, and they printed out the email from the wife saying, we made the company a 50-50 ownership, and the previous preparer took that, put a little check mark by it,
and moved on.
And changed it on the tax return. And now for 2 years, the tax return filed as a 50-50. And now in the divorcing, he's got all the operating agreements say he owns the thing 100%. And she's now on 50-50. Like,
did you get called in for litigation for this?
No.
For
Yeah. Long story to it, but thankfully no, because that is where that would have gone. Like, this was just...
Who signed the S corp? He or she?
Her. Him? Ugh.
Because here's the weird thing about your story is the problem here is okay, let me say it this way. The piece of paper that we're going to call the legal documents, organization documents, all that kind of stuff, those are papers that can be changed at any point in time.
Right.
The only place that this ownership change will ever take place legally is on a federal document, right? So that's the tax return. So how did this land? Did she get 50% of the company, or was he able to prove that this was not intentional? Like, he had no saying on it. He didn't gift her shares.
No, and I want to say, well, yeah. There's more to it, and let's go with this. Neither of them are my clients at this point.
Okay, cool. So that's good.
Because the way that it was resolving, I was not going to be able to resolve everybody's angers and frustrations, and so we helped them find new homes.
Yeah. Yeah.
It's okay to let people go.
Yeah. And it's sad, but I do it all the time too. I mean, it's one of those things where at the end of the day, none of my clients can pay me in time. You know what I mean? And it's important to me. Time is important for everybody, obviously. But like I've got a 4-year-old and a 6-year-old, and I'm a small business owner. I've got lots of employees that help do a lot of stuff, and they're great. But at the end of the day, when a client comes in and doesn't do their part of the job or to try to assist, like I'm not interested in you causing me more time to do the same thing I do for everybody else, but you cause me more time because of your lack of planning
Yeah.
or your lack of organization.
Yeah.
I'm not interested in doing that long term, and it's not a knock against anybody. It's just there's other professionals out there that are willing to put up with, you wasting their time. I'm not.
Yeah. Yeah. So I think that's, and that horror story is multiplied in multiple ways, but it's just at the end of the day, so many people do things legally. And unfortunately, what I tend to see is not enough tax pros actually ask for the legal documentation. And then they just do either what the client said or what they assumed. And almost every one of them is like, that's the horror story is it's like, oh, my previous person never asked. And I'm like, well, because we ask for operating agreements, we ask for
Yeah.
purchase agreements, we make sure stuff's titled right. Like all of that stuff does matter, because then the flip side is if it doesn't get done right at the start, it always blows up at the end. And
Yeah.
so when you go to sell, when you go to exit, when you go to divorce, or what, all of it is like, it's so yes, I find that I'm like the cleanup crew a lot, because I'm like an investigator. So I'm a
Yep.
I'm a very good investigator.
And I'll bet you don't run into that scenario again, because that taught you some lessons. Be like, I want some rock solid stuff, proof that you changed and you signed off on this. Or that wasn't even you though. That was the previous preparer that did
Yes.
it, and you just followed suit, and you wouldn't have
Yes.
known.
Right. Well, and it did though, and even in that, it changed that we, so with like previous, we didn't have operating agreements when we had clients that we acquired, because they weren't, it's like we asked for them, but not everybody had them or given to them, and we made it like an actual requirement that we have to have it,
Yeah.
because that was exactly the situation, and that happens with, that happens with unrelated parties and related I mean, those operating agreements, I just had another one this week. I mean, I've got 2 conflicting documents that they said one thing, they handed me something that says another. They literally have an asset purchase agreement and a revised membership agreement indicating change of ownership. I'm like, well, which is it?
Yeah. You got 2 different documents here. What are we talking about?
So
Gosh.
just every day is like a new, fresh.
A new challenge. You never know what you're walking into.
I never know what I'm getting. Yeah.
And and just to kind of probably wrap us up here. I mean, it's clear that no matter what the tax situation is, whether you're a W-2 employee with retirement or HSA or any of this kind of other stuff, there is no tax situation that's the same. There is no tax situation that is simple. It's rare to have a completely simple tax situation that you couldn't benefit from a qualified tax pro. And if you're looking for ways to save money on tax, like the only way to do that is, guess what? You got to have a conversation with a qualified tax pro. I know that's a unique thing. If you want to, I'm about to make a Tommy Boy reference. Please God, have you seen Tommy Boy?
No.
Well, the joke in there
Who
is
is
that
Tommy? Who is Tommy Boy?
it's Chris Farley.
I know who that is.
Yeah, that's great. That's a start. But there's a joke in that movie that basically you can get a good look at a T-bone by sticking your head up a bull's something. But wouldn't you rather just take the butcher's word for it? But I don't know why I wanted to tie that into like, hey, you actually have to go talk to a tax pro and sit down and have a conversation. And now, Kelly, you've got to go watch this movie because you need to hear that quote that it's said at least two to three times in that whole movie.
Okay.
Chris Farley's character screws it up a bunch, but the moral of the story was his dad said it once and he thought it was really funny. He could never repeat it the exact way for that joke, except for once. So, but you know, I hope this session was a situation where this brought some levity or some clarity to some of your tax situation. And please don't forget to subscribe, share, join us wherever we're at on the tax world, one conversation at a time. Thanks.